Cathie Wood is back and she is tweeting, and she does not think that the Fed is doing the right thing. Now, this is no surprise given Cathie Wood and the camp that she lives in, but she thinks the Fed, not pivoting, which, by the way, a pivot doesn't mean you reduce rates from 75 to 50, where we're talking about basis points on interest rates. It means you stop, right? A pivot is traditionally defined as like the Fed stops raising rates. Cathie Wood has tweeted today that the bond market seems to be signaling that the Fed is making a serious mistake. At negative 80 basis points, as measured by the 10-year versus 2-year Treasury yields, the yield curve is more inverted now than any time since the early 80s when double-digit inflation was entrenched. Now, what does this mean, this first tweet, before we get into the rest of the tweet thread? When the 10-year and the 2-year Treasury yields invert, well, first of all, what is the 10-year, 2-year Treasury yields? Basically, I could either invest in governmental bonds or I can invest in stocks or real estate or anything else. But for the sake of clarity or simplicity, let's use governmental bonds versus stocks. If a 10-year bond is giving me 3.7% return on my money, that's for the example, which is roughly where the 10-year is right now. And I put, I put some money in there. If I can get 3.7% with zero risk, why would I not do that? I would always want to get 3.7% on my money, especially if the risk I have to take in investing in stocks is stronger. If I invest in Apple, one might be like, well, Apple's a great company. Why wouldn't you put your money in Apple versus a 10-year or 2-year bond that is giving you 3 to 4% interest rates? Well, the problem is that 3 to 4% is guaranteed in one sector, and Apple, they still have to put up another $90 billion in revenue, because like they did in the last quarter, they put up $1 billion a day in revenue. They have to beat that. They have to grow, continuously grow. And if they can't continuously grow, my money at the valuation I buy them at, which would be right now about 2.5 trillion, will not grow as well. Timing matters when you get into a certain stock. And so in general, if the macroeconomy is going down, if a potential recession is happening, if stocks in general are a little bit more riskier to invest in because interest rates are going higher, which means growth stocks get hurt more because interest rates are higher, then more investors take their money and they put them in lesser risky assets, which would be bond yields, which means they don't invest in stocks. And the whole reason is because they want a return on their money. Everyone wants a return on their money for the least amount of risk. So when the 10-year and 2-year bonds invert, it signals there's likely going to be a recession, because if I'm giving my money out for 10 years, I should be getting a more bigger return on that because I'm giving out my money for a longer amount of time. But when the 10-year and 2-year convert, that means I'm getting more for my money for giving it for a less amount of time for 2 years, which doesn't make any sense, right? If I give you $10,000, I expect to have more for that $10,000 over the course of 10 years than over the course of 2 years. Like, I should be theoretically getting more for my money because I've given it away for a longer amount of time, right? So given the nature of time and compounding interest, I should just be able to get more money if I give it more time. But if I'm getting more for my money in a 2-year Treasury yield than a 10-year Treasury yield, that is what we call an inversion, and that historically has always signaled a recession. So Cathie's argument is like, if this is already happening and the inversion is now at a larger inversion at negative 80 basis points than the inversion in the 1980s when double-digit inflation was already entrenched, which, by the way, right now, it is not double-digit inflation. It is 7.7%. Then that means the Fed is making a serious mistake. She continues to say, I'm wondering why economists are not highlighting the 80 basis points inversion of the Treasury yield curve today as much more of a red flag for the Fed than it was in the early 80s. As a percent of the 3.5% 10-year Treasury yield, it is 23% today versus 5% of 15% in the 80s. Basically comparing that the level of inversion that we're having right now is significantly more than the level of inversion that we had relative to the level of interest rates relative to the inversion yield that we had back in the 1980s. She also says, typically an inverted yield curve is pointing to a recession and or lower than expected inflation than expected. In our view, deflation is a much bigger risk than inflation. Commodity prices and massive retail discounts are corroborating this point of view, which means like her core thesis here for why deflation is likely coming is not only because of advanced technologies that are going to deflate things with artificial intelligence, which she's not wrong about. I mean, the cost to train an AI model is decreasing 50% year over year. So like there is absolutely a case for deflationary technology from something like a vertical like artificial intelligence, but also her argument about commodity prices and massive retail discounts corroborating this point of view that we're likely not going to see higher than 7.7% inflation. We're likely going to go down to maybe 7.3 in the CPI in the next couple of weeks, and maybe even go lower than that starting by January, February, potentially even to 4 or 5%, which the Fed wants to get to 2%, but 4 or 5 wouldn't be horrible. She finally says, surprisingly, the S&P energy sector XLE price is not far from an all-time high, even though the price of oil has dropped from 130 per barrel to 74. So the S&P energy sector price is almost at an all-time high, even though the price of oil has already dropped more than, call this $50. Meanwhile, many pure play early stage innovation stocks have dropped below their coronavirus low. So energy index is up at all-time highs, even though oil is down. And, if oil is down, then energy has to theoretically be down, right? Because not that many people are going to be paying for energy. But early stage innovation stocks like Zoom, Roku, Coinbase, etc., are down below their coronavirus lows, hitting new lows, dropping 70-80% year to date. She ends it with the truth will win out. Now, the fundamental problem I have with Cathie Wood, I understand her argument about 10-year and 2-year inverting. I understand her argument about how it's inverting at a deeper level than it was in the 1980s. And I understand her argument about commodity prices peaking and deflationary technology coming into place, which means they're more likely than not, there's going to be some level of deflation in the economy, which is going to cause the Fed to not have to raise interest rates or at least pivot and stop soon. The part I don't get, and this is the part I would like someone to explain to me because I really don't understand this part. She says the yield curve is now more inverted now than at any time since the early 1980s when double-digit inflation was entrenched. So her argument is, in the 80s we had double-digit inflation. Right now we don't have double-digit inflation, but the yield curve is inverted even more now than it was then, which means the Fed needs to stop. My simple rebuttal to this is that the 1980s is different from 2022. And this is the part, Cathie Wood has made a bunch of threads on this idea that the rate at which we're raising interest rates is like 16 times higher than the rate at which we were raising interest rates when Paul Volcker was raising interest rates, right? So he's like, this Fed is crazy. But again, that was the 1980s. I just don't understand this argument because you cannot do a historical comparison, in my opinion, when it comes to the 1980s versus 2022 because technology is different. We didn't have the internet in the 1980s. We didn't have a pandemic that wiped out an economy for 2 years and that cost $7 trillion of liquidity to flood the system, which is a different type of reason we have inflation. Like in the 1980s, inflation was happening for a totally different reason than the inflation that's happening now. It was just an overstimulus of the economy because we thought the world was going to end and we thought people wouldn't be able to pay the rent. There was a fundamentally different argument for why inflation is happening right now. So yes, history repeats itself and history tends to rhyme, and you look to historical indicators as a way for measuring different things and benchmarks. But at the end of the day, the 1980s is not 2022. So to make the argument that in the 1980s we were being less aggressive than we are being right now doesn't take into fact that $1 in the 1980s is just not worth $1 in 2022. That doesn't mean there aren't certain similarities that we can call upon those things and try to understand and gain a better perspective from and probably inform monetary and fiscal policy. But it does mean they're different. And it does mean when they're different, that means we have to have different perspectives and different point of views. And I think the Fed has made an argument. And by the way, I think the Fed might be in a spot where they need to slow down as well, especially if CPI comes in relatively low, which we'll see in the next couple of days. But I think the Fed doesn't want to make the mistake that they made when they said inflation was transitory. And if inflation does not go down, we are in a bad situation. And I think we just need more data to be able to figure out if that's going to happen. Cathie Wood believes that it's already going to happen. Cathie Wood believes there's no way inflation has not peaked. There's no way that deflation does not start to come into the into the ecosphere. I think the Fed has to make a decision, and the Fed has to sort of really evaluate, hey, do we think this is happening? Unless we have all the data we need, we're going to keep raising rates to make sure. The Bank of Canada today raised interest rates by 50 basis points as well. Their CPI coming in at 6.9%, the United States at 7.7%. So it's not the United States Fed alone being hawkish. It's a lot of countries across the world saying, hey, we need to do some more quantitative tightening and get things in place because it's really difficult for us to just be like, yeah, everything's fine, deflation, innovation, tech, it's going to come back. It's going to save everything. It's like, the Fed can't be able to make that decision right now. So let me know your thoughts. Is Cathie Wood right? Is she wrong? Is she using wrong historical predictors? Is she in the right spot? Is deflation actually coming? We'd love to know your thoughts. Thanks so much for listening, watching. I'll see you in the next one.